Hello and welcome to another video on how to secure yourself financially. Because I was reading about the beginner guide to financial statement, okay, and to make myself familiar with the concepts, what financial statement after all do. They show you the money and what are the type of financial statements, like the balance sheets that show what a company owns and what it owes at a fixed point in time, the income statement, how much money a company spend and make over a period of time, the cash flow, which it shows the exchange of money between the company and the outside world, as well as the statement of the shareholder that show change in time over the shareholder interest. Okay, so this change over time, or this change in interest of the shareholders, the statement is the statement of the shareholders' equity. Okay, that show is the change in interest in the shareholders over a period of time. So this section only focuses on the first three, right? The balance sheet, the TLDR, which is a snapshot of the company's assets, liabilities, and shareholders' equity, as well as the income statement, where the bottom line of this show it shows if a company made or not a profit, and the cash flow that report if the company inflow and outflow of cash. It reviews the information from the balance sheet and the income statement, and the bottom line of this show the net increase or decrease in cash. So this statement review the cash flow from one of these activities: the operating activities, investing, and financing. So operating is can be break down into operating assets and operating liabilities. So where the most common operating assets are accounts receivables, property, plant, and equipment, prepay expense such as insurance premiums, rent, marketing, software license, maintenance contract. Intangible assets is another most common operating assets, like patents, trademark, copyright, trade secrets, customer relationship, goodwill, as well as the investment in affiliates like joint ventures, equity investment, limited partnership, associates, and cash equivalents, okay, such as money market funds. So this money market funds involved is the purchase or sale of a very large volume of short-term debt financial instruments, such as bank acceptance, certificate of deposit, commercial paper, repurchase agreement, or U.S. Treasury bill or Treasury bill. Now, when it comes to the most common liabilities, we have things like accounts payable, money that you owe to your suppliers and vendors, usually between the 30 to 60 days, for things like office supplies, raw materials, service, accrued expense, so expense that a company incur for good and service that has been received but not yet paid for. So, for example, administrating in salaries, rent, utility bills, taxes, deferred revenue, which are based on money that the company has collected. It is an obligation to provide future good and service in the future. So subscription servers are a good example of that. Gift cards, income taxes payable, money that the company owns to the government, such as corporate taxes or withholding taxes, which is a tax that the employee deduct from the gross wage salary employees and paid back to the government. So the employee deduct a portion of the gross wage salary of the employee to pay back to the government, and this is to promote the pay-as-you-earn tax system and fight tax evasion. Okay, so also sales taxes such as local, state, federal, foreign, VAT, the value added tax, which is a tax imposed at every stage of the production of good and service, where the customer ultimately pays the full VAT, and business along the supply chain remit that portion to the tax. Excise tax, which is a tax imposed on certain good and service, such as alcohol, tobacco, gasoline, guns. GST, the good and service tax, which is a tax imposed on the VAT. Keep looking at another most common operating liabilities like short-term borrowings for companies that need to meet their financial needs, such as bank loans or line of credits. Also issuing bonds, outstanding invoice. When he showed that to a lender, the lender analyzed that and evaluate based on the value of that invoice how much money it's going to provide. Payroll advance, but this is now for employees that ask for an advance that will be deducted in the next payday. So also I look at notes payable, something very, very important, because this is an agreement between the borrower and the lender that outlines all the terms and conditions of that loan. So for example, anytime you go to a bank and ask a loan, so it generates these notes payable, outlining things like the principal, the interest, the repayment schedule, and so on. So business, so for example, venture capitalists or private equity, they generate is a notes payable between the company and those institutions. So government bonds or corporate bonds actually generate this notes payable. Also, single notes payable to individual or small business. Your supplier, supply, or in this case, trade payables. But this is now when you go to renegotiate with your suppliers and vendors. So also look at the warranty obligations, which are obligations that a company have to fix or replace an effective product or a product that doesn't meet certain quality standards. Okay, so you have things like manufacturing warranties, service, part, vehicle. So looking at these most common operating assets and liabilities, okay, and how the first part of the cash flow review the cash flow from all of these activities, and the way he does that is to conciliate with the net income from the income statement, okay, and this net income is after you deduct all of the expense associated with the total amount of revenue, okay. So it adjusts this with the total amount of cash that was used or perceived from. So by looking at the net income and conciliate with non-cash items or items that affect the company or the inflow, the income statement of the company, and they call non-cash because there is no cash involved, okay, such as amortization and depreciation and stock-based compensation. So the second part of the cash flow statement is the financing activities. So if we take a closer look here at the apple here, investing activities, I mean. So the investing activities refers usually to the purchase or sale of long-term assets, such as property, plant, and equipment, investment, as well as intangible assets, leaseholds improvement, okay? And the third part, the financial activity that focuses on how a company is raising funds and pays back to investors or creditors through through capital markets. So the point of this is to understand that this financing activity involves in the company's long-term liabilities and equity. Usually you call equity as ownership, or to be more technical is if you have an asset, once you pay all of its liabilities, what left is what you own. So because the most common activity involved in the financial activities are raising funds from investors or creditors, repaying debt, and then share dividends. Most common example of this are issuing equity. So for example, when a company goes public, it issues a certain amount of shares, or issuing debt. So a company wants to raise funds by issuing some financial debt instruments like debentures or bonds, notes payables, repayment debt, repurchasing stocks, as well as a leasing, which is an agreement that a company offered to another company for the right to use a particular assets, building, equipment, without taking ownership of that. And so with that, okay, then I look at when it comes here to the financial cash flow, how this section is so important for investors because it can help how often this company is raising funds and where these funds are coming from. So if a company, if the cash flow of the company comes primarily from its operations, that's a good sign of a business. However, if it's constantly relying on taking out of debt or issuing equity, might not be a good sign of it. Again, this is an oversimplification of the life, of the real life events. So then I look at the footnotes and how important it is to read the footnotes, because it packs with some information like significant accounting policy and practice. So how these companies are adhering to accounting practice, such as GAAP or EFRS, okay, which is important that company, and it's required that company disclose that, okay. Fun fact is that the GAAP, this generally accepted account principle, was defined after the 1929 market crash. So, well, why I brought that out? Because most of the time, historically, the things that we have, or the thing that we have learned, or most of the time we learn from our mistakes rather than our prevention. So you can imagine is who was the first person that actually know that drink milk from cows is doable, okay, to now the market crash in 1929. So you get the idea. Now, so another important note the company have here is, well, the income tax payable, that this is in this section is described in more detail. For example, if you go to take a look here, so income taxes in here described with more detail about the local, state, federal, or foreign taxes, whether it's deferred taxes or current taxes. Also, the pension and post-retirement program or any other retirement programs, so pension plans or any post-employment benefit programs. So here it describes specific information about the assets, the cost of this program, as well as if the program is over or underfunded, and the stock option, which is a kind of compensation, between a company to its employer, where stock option is a financial instrument. And when we talk about financial instrument, according to Wikipedia, is an asset that can be traded, or it also can be seen as a package of capital. So this financial instrument, stock options, allows the owner to, or the stock options is a financial instrument that allows the owner the right, but not the obligation, to purchase an asset at a given agreed upon date and price. Okay, so there are two types of options. You have puts, where you will bet that the stock will fall, or calls, bets that, or a bet that that the stock will rise. So this option, or this stock option, is also known as equity options or derivatives, meaning that the value is determined based on underlying assets or a group of assets with a benchmark. Okay, so with that knowledge, right? Then I look another section important in every financial statement, which is the MD&A. Okay, so you can find a narrative explanation here. So I actually asked ChatGPT to summarize this section here. So hey, ChatGPT, help me to summarize this section. Okay, and provide me that with 100 or using 75 words. So it says that the management discussion in the management discussion and analysis of financial conditions and results operations is a section in quarterly or annually reports where a company provides a narrow explanation of its financial performance. So after all, the management discussion and analysis of financial condition and results operations, such amount, huge name, man, huge name. So the MD&A, again, this management discussion and analysis of financial condition and report and result of operations is a section quarterly or annually that describe or that provide a narrative explanation of its financial performance. So it allows management to share their perspective on the financial statement. Something very, very important. So it allows management to share their perspective on their financial statement. Important trends and risks that have impact or may shape the company's future. So for example, if I take a look here at the Apple here, but in this case I just want to look at the Apple MD&A, okay? The SEC feeling, okay? In this case, let me see if I can see this. Report quarterly, okay? In the report quarterly in PDF. Okay, so this MDA, this management discussion and analysis of financial conditions of financial condition and results of operation. Okay, so if I take a look at this, financial statement, management discussion and analysis of financial condition and result of operations, a very long long name, man. Quantity and qualitative disclosure about market risk, controls and procedures. Legal proceeding, risk factor, and register sales of equity security and use of proceeds, defaults upon senior security, mine safety, other information and exhibit. But after all, what I'm doing is take a look at the most important part, okay? So the financial statement, the management discussion and analysis of financial condition and results of operations, okay, is a section here that quarterly or annually that provide a narrative explanation of the financial performance of the company financial performance. Okay, so it shows the trends. Okay, something that they mention here. So it allows management to share their perspective on financial statement. It allows the management to share its perspective of financial statement, important trends, okay, important trends and risks that have shaped, okay, and risks that have shaped or may, and risks that have impact or may shape the company's future, which is required by the SEC and aims to give investors necessary information to understand the company's financial conditions and result of operations, providing context for the financial statement and earning information. Okay. Americas, Europe, Greater China, Japan, and rest of Asia. So this MD&A provides this narrow explanation of the company financial performance. This is something very important for employees to know what's going on. You know, to actually know what's going on. So here it describes its important trends for on the management perspective, and risks that have impact. Okay, for example here, risks that have impact or yeah, risks that have impact or may shape the company's future, So this is required by the SEC, and it aims to give investors necessary information to understand the company financial condition and results of operation. Much like when you hit the gym, you have a fit condition. Much like this MDA, is show from the management perspective the financial condition and result of operation. Okay. All right. Okay. So next, so something somewhat important here, for example, to show important trends or risks that have impacted the company. For example, in Americas, iPhone, they have the net sale decrease during the second quarter here. Dollar has a net unfavorable year-over-year impact on Europe net sale during the second quarter. So the Europe net sale decrease consisted primarily of lower net sale of Mac, partially offset by higher net sale of iPhone. Greater China, the weakness in the renminbi relatively to the US dollar has an unfavorable year-over-year impact of Greater China's sale. In Japan, and the weakness in the foreign currency relative to the US dollar had an unfavorable year-over-year impact of the rest of Asia Pacific net sales, meaning that Apple have suffering from a decrease in net sales in Americas, Europe, Great China, Japan, and rest of Asia. And product and service, so with iPhones, they remain flat. From Mac, they decrease in the second quarter. From iPad, it decreased, net sales decrease. And from home wearable accessories, they remain flat compared with the last year. But the net sale decreased the first month of the 2023. And service. Service net sales increased during the second quarter and first 6 months of 2023 compared to the same periods in 2022, due primarily to higher net sales. Gross margin. Okay, so now this is when comes things like that, like financial statement ratios and calculations. You have probably heard people banter around phrases like PAA ratio, current ratio, and operating margin. Okay, so for example, operating margin, current ratio, PA ratio. But what does these terms mean and why don't they show up on financial statement? Listed below are just some of the many ratios that investors calculate from information on financial statement and then use to evaluate a company. As a general rule, desirable rates vary by industry. If a company has debt to equity ratio 2 of 1, okay, it means the company has $2 of debt to every $1 shareholder invested in the company. In other words, the company is taking on debt as twice the rate that its owner are investing in the company. Exactly. Inventory turnover ratio, cost of sales slash average inventory for the period. If a company has an inventory turnover ratio 2:1, cost of sale, it means the company inventory turns over twice in the reporting period. If a company has an inventory turnover ratio 2 to 1, it means that the company inventory turned over twice in the reporting period. Inventory turnover ratio. Turnover. Inventory turnover ratio. If a company has an inventory turnover ratio of 2:1, it means the company inventory turned over twice in the reporting period. Operating margin, income from operations slash net revenues. Operating margin is usually expressed as a percentage. It shows for each dollar of sales what percentage was profit. And PA ratio, price per share slash earning per share. Operating margin. If I take a look here, this is gross margin, service gross margin, operating expense, provision for income taxes, liquidity, critical assets, legal procedures, risk factors, and registered equities, and the signature. Timothy D. Cook, Chief Executive Officer. The answer. Luca Maestri, certified that. Senior Vice President, Luca Maestri. Apple Leadership, Luca Maestri. Senior Vice President and Chief Financial Officer. Prior to joining Apple, Luca was FCO at Xerox. Okay. And previously at Nokia Sims Network. Luca graduated from Louis University in Rome with a bachelor's degree in economics and earned master's degree in science of management from Boston University. Mhm. Interesting. Look at maestri. Okay, holy. Oh my god. Oh, okay. The big players, man. The big NBA players here. Interesting. So this is the MD&A, and keep looking at this. So you have probably heard people banter around phrases like PA ratio, current ratio, and operating margin. But what does these terms mean, and why they don't show up on financial statement? List below are just some of the many ratios. Okay, so the list below are just some of the many ratios that investors calculate from information on financial statement, and they use to evaluate a company. As a general rule, desirable ratios vary by industry. But again, this is a list of some of the many ratios. So if a company has a debt to equity ratio 2 of 1, it means that the company has $2 of debt for every $1 shareholder invest in the company. In other words, the company is taking on debt as twice the rate than its owner are investing in the company. Inventory turnover ratio. So this is something that I get. Okay, debt to equity ratio. So for example, if I take a closer look here on Apple, debt to equity ratio. Apple debt to equity ratio. Macro trends. The debt equity ratio can be defined as measure of the company's financial leverage, calculated by dividing its long-term debt by stockholders' equity. It is long-term debt by stockholders' equity. Apple debt equity for 3 months ending was 1.56. Exactly, the ratio is low, meaning that the company is profitable. However, if the debt to equity, it means that at the beginning there was this phase of earning. Okay, I get it. Interesting. But this was a good moment to sell that because you're not going to earn anything. Because the debt to equity, okay, because the debt to equity at those moments, debt equity is a company's is for any dollar a shareholder invest, you're getting the half. Interesting. Interesting. Inventory turnover ratio. Cost of sales average inventory for the period. If a company has inventory turnover ratio 2 of 1, it means that the company inventory turnover twice in the reporting period. Operating margin is equal to income from operations less net revenue. So operating margin is usually expressed as a percentage. It shows for each dollar of sales what percentage was profit. Operating margin. Operating margin, this is something that they don't mention that. Operating margin. Nope. Okay. Operating margin. What percentage was profit? Price per share, earning per share. If a company's stock is selling, PA ratio, which is PA ratio. Price ratios. PA ratio. Okay. Price per share and earning per share. If the company stock is selling $20 per share and the company is earning $2 per share, then the company PA ratio is 10:1. The company stock is selling at 10 times it is earning. The company stock is selling at 10 times it is earning. In this case is selling at 32 times since 2010. In how long? In holy no, put this in 2013. No, but this is earning per share, PA ratio. Exactly. This is 12 and almost 20%, almost 20 points in 10 years. Damn, son. 20 points in 10 years. Starting from here. 12. It's 20 points in there. Price per share, earning per share. Okay. And keep reading off the PA ratio. Working capital, which is equal to current assets minus current liabilities, something that I'm quite familiar with. And again, this is one metric to measure is the financial health, the company financial health. Debt equity ratio compares a company total debt to shareholder equity. Both of these numbers can be found in the company balance sheets. To calculate debt equity ratio, you divide a company total liabilities by its shareholders equity. Okay, the total amount of obligations by the amount of equity to get the debt to equity. Inventory turnover ratio compares a company cost of sales on its income statement with its average inventory balance for the period. To calculate the average inventory balance for the period, look at the inventory numbers listed on the balance sheet. An operating margin and PA ratio. So I'm going to take slowly here. So with that, that'll be all for this video. Take care. Bye bye.